Good evening, everyone, and welcome to our first MLP Wealth webinar. I can see quite a few of you have joined already. We will start straight away. One quick point, if there's any problem with the audio, please do let us know. We've decided not to use headsets, so just pop something in the chat if you're having any problems. We can always change that. The idea of these webinars is to provide an additional level of service for our clients. As you know, when we're dealing with finance, we're dealing with a number of variables that are constantly changing, whether that be taxation, legislation, rules surrounding products, etc. So the idea is sessions like these give us a useful opportunity to share information with you and potentially for you to ask some questions. Plan is going to be to run quarterly webinars covering different topics, and we'll kick off today with Sean talking about changes announced in the last budget by Rachel Reeves with regards to inheritance tax, or IHT as we call it. Now, prior to the budget, we already were considered to have one of the harsher regimes worldwide, and unfortunately it looks like it's going to get considerably worse for some of you. So we're going to start off with a refresher, give you a reminder of how IHT works, cover the recent changes that have been announced, the consequences for people like yourselves, and some potential solutions. So just before I hand over to Sean, a couple of housekeeping bits and pieces. Please do keep your mics turned off just because of background noise. We are supposed to have a fair few attendees, so it can get quite hectic quite quickly. Second thing, we're going to try and stick to the advertised 45 minutes. I'm sure some of you want to get back and watch the football. I know Sean does. And in the interest of time, not running over, we will deal with all questions at the end. So please, if something comes up during the presentation, you want to ask a question, either drop it in the Q&A box at the bottom or the chat, and we'll try and keep up with both. We'll get through as many as we can, time dependent again. So don't worry if we don't get around to answering your question. There is actually a slide with QR codes where you can book a follow-up call with either Sean or me, and also our contact details. So finally, we will be recording this, and a recording will be sent to all attendees. So don't worry if you don't want to take any notes or you need to refer back to things, because that's all covered. So that's all from me. I'm going to put my mic on mute now, and I hand over to Sean.
Hello and good evening, and welcome to the seminar on Is Your Pension at Risk of 40% Inheritance Tax? So we've got 4 smart strategies to shield your estate and 2 bonus solutions. So maybe it's everyone's lucky night because we've actually got double the amount that we originally advertised. So just first and foremost, I'm just going to go through an agenda of what we'll cover. Paul partly mentioned this, but to start with, I just want to touch upon who we are. So a few of you might not know us that well, but it was also a good background for everyone, I think. We'll then talk about the problem. What is the problem itself? Then we'll go through those solutions. And finally, there'll just be a summary before we go to that question and answer section, the Q&A. Really do encourage people to ask questions. We want to keep this fun. We want to keep it interactive. Makes it more interesting for everybody if we've got real life questions. Don't feel there's any question too silly. This is, as we say, a safe space, so please do ask. We want to hear from you. So, who are we? Here's a picture of our team, MLP Wealth Management. So we're a family-run business. Our father set the business up actually over 40 years ago now, so 42 years roughly we've been running. Paul and I bought our father out in June 23. We've both been in the business far longer than that. Paul over 20 years, me over 10. We're also independent. Now, what does this mean? This means we're not tied to any particular provider. Anything, therefore, that we recommend is something that's based on deep research, and we genuinely believe, well, we don't believe, but we're convinced these are the best things we can find people. This is something that is really important to us. This is really, really important, why I highlight it. We're also chartered. So again, what does this mean? This is a recognition of our level of qualifications. So to be a financial advisor, you have to be qualified. But there's a higher level of qualification that would make you chartered. Both Paul and I are chartered, and we're also a chartered firm. It is also a recognition of our experience as well. So how do we help people? So one way is retirement planning. Clearly, tonight we're going to touch upon pensions in a quite specific manner, but it could be that someone has built up money in pensions. They could be quite young and it's worth maybe reviewing them. Could be you've changed jobs, might be worth reviewing them. It could be that you want to know, when could I retire? Or you have a target retirement age. Could I do that? Or you could be approaching retirement or even in retirement. So really, as we say here, retirement planning. Tax efficient investing. So what I mean by this, generally things like lump sum investments. Could be money that you've saved up. It could be money that you've inherited. Could be a common one is cash, maybe from a sale of a buy-to-let property or a downsizing. So we can help invest that tax efficiently, but also where to invest it. We also help with inheritance tax planning. Of course, we're touching upon this again today, but we do it as a standalone piece. A couple of other things that we help with that aren't here, things like business owners, we add a lot of value, as well as people maybe going through divorce, as well as other things. So this list isn't exhaustive, but this is just a few areas. So we're top rated. What does this mean? We featured in the Times top advisors in the country, so the top individually. We featured in the top 250 advisors. There will be another one coming out, a guide in the Telegraph on the 25th of June, and we've featured in these since the inception over 7 years ago. We also featured in the top firms in the country, so top 130 firms. I'm very proud to say that we're also the only one to feature in Banstead, where we're based. Now, we featured in this because of our client feedback, and that's very high, it's very good. So this is why we're quite proud of it. We also have a high Google rating, something we have asked people to give more recently. So enough about us. What are we here to talk about? Inheritance tax planning, and it's charged at 40%. But it's important to, first of all, understand what it is and how it works. So inheritance tax is really quite a harsh tax in that not only are we taxed within our lives, but also when we die. However, sometimes it is known as a voluntary tax, as the good news is you can plan for it and potentially reduce it or even maybe mitigate it. So first of all, everyone has what's known as a nil rate band. And what this means is that if your estate is worth, well, and that nil rate band, sorry, is 325,000 per person. So anything up to that is not taxed. An estate's worth more than that may have to pay this 40% tax. The thing about this is it's been fixed since 2009 and it's been extended until 2030. What does this mean? Well, this means that as inflation is going up, as we see the impact of that, as assets grow in value, this allowance has not increased. And it means that this isn't a tax on the super wealthy, super rich. More and more people are getting bought out. So the government took 7.4 billion in inheritance tax receipts in 2023, and this increased to 8.2 billion in 2024. So the point is, we only really see this increasing the way things are going. But there is something else known as the residence nil rate band, and that is 175,000 per person. So this is another band that if you qualified for, you would have. So some of the things are that it's for residence nil rate band. This must be for a house that you own, must be your main residence, and you must leave it to direct descendants. If you qualify, you could therefore have total allowances of 500,000. So I'm just adding together the 325,000 and 175,000. But there's something else to note around this, and that is that there is tapered for estates worth over 2 million. And what this means is that for estates worth over 2.35 million, you won't have it any longer. Now, unfortunately, it gets worse. So Mrs. Reeves here came out with the news that in the budget, the pensions will be in the estate from April 2027. But it's important to understand what's included in this. So what we call, I've abbreviated here, defined contribution, DC pensions, or sometimes known as money purchase pensions, you may think of it as a pension pot. So for example, if you're a client of ours and you hold a pension through us, more than likely it's one of these. Somewhat surprisingly, annuities are going to be included within this. Now, I put TBC because we don't understand how, because they don't understand themselves and come out and explain how they will calculate the value of them. It's also important to understand what's excluded. So defined benefit pensions are not included within the calculation. So these are pensions, you sometimes may have heard of them as final salary pensions. They are pensions that will just pay you an income in retirement, but they are specifically named defined benefit pensions. And surprise, surprise, the government have defined benefit pensions, but I'll leave you to mull that over on your own. Now, unfortunately, it gets worse if you die over the age of 75. So we've discussed that there could be inheritance tax due. But the thing is that if the money in the pension pays outside of the pension, what we call the pension wrapper, it will also be assessed as income and therefore potentially taxed. So what we call at the marginal rate of income tax. So let's just take a very basic example. Someone is aged over the age of 75. The pension does pay outside the pension environment, the pension wrapper. Well, in this scenario, there is inheritance tax due. We know that's 40%. But actually, if income tax is due, that could be up to 45%. So for example, if you had a pension pot of 200,000 and that pays out to somebody outside of the pension and you're over the age of 75, that will just be deemed as an income. You also lose your personal allowance. And it's said that once you lose it at that amount I'm talking about, you're equivalent of a 60% taxpayer. The point here is just to note that not only potentially is there inheritance tax due, but also income tax. So look, we've mulled over the problem. Well, what can you do about it? So this is the stage where we're going to start going through the solutions. So we've got the four main ones with two bonuses. So the first one is, well, you could spend it. So it might sound like I'm being a bit flippant here, but this is a real consideration. So we often discover or come across people that die with large sums of money, having been quite frugal, been cautious with their money and saving. And what they're not doing is enjoying their lives. And one of the reasons sometimes why people do this is because they don't have the confidence or peace of mind that they have enough to be able to spend more. And this is where something like cash flow forecasting can really help. So, of course, this is something that we help with. And what this does is it assesses your whole situation, takes into consideration all your assets, your incomes, your expenses, how we expect them to change throughout time. And then based on that, do you have enough money for your lifetime? And if it shows that, well, potentially you've got more than enough, that may just give you that peace of mind you could spend a bit more. Slight caveat, of course, when you're doing this, it's forecasting, it needs to be regularly reviewed. It's not going to be perfect, but it is a really, really good tool for this kind of thing. And when I'm talking about spending it, of course, this means, spending it on those life experiences, which most of us will have heard, tend to lead to more happiness than just material things. So the reason this spending it works is that it reduces the value of your estate. So just going back to the material things, if you're buying some kind of asset, of course, this wouldn't necessarily work. And for most people, this isn't going to be a full solution, but it's just something definitely to consider and be aware of. The second thing you could do is insure it. So what am I talking about here? So you could have a whole of life insurance policy. And what you do is you insure the inheritance tax liability. And then you place it into trust. And it's really important that this is set up correctly. So for example, if it doesn't go into trust, say you've got a policy and then it pays into the estate, well, it's just inflated the value, there's more 40% inheritance tax. Now, there is a monthly premium to be paid for this. It needs to be assessed with underwriting. Not everyone can potentially get cover, or it may cost a bit more than you were expecting. So really important that this is looked into, it's done properly. What we typically find with these kind of policies is that they pay out way more than someone actually pays for the monthly premiums every month within their lifetime. To put this in context, if I could offer an investment that would offer those kind of returns as such, people would be jumping at it. So definitely something to consider. And again, by the way, it doesn't necessarily have to be for the full amount. The next one, most of you would certainly have thought about this if you've not done it, and certainly heard of it, and that's to give the money away. So this typically takes 7 years, and it must be a real gift. What we call, it can't be a gift with reservation. So you can't be benefiting from it. It really must be a gift. Now with gifts, there are some small allowances though. So for example, you can give £250 as a small gift allowance to as many people as you like each year. And this is so long as you've not used another allowance with that person. So some other gifts that you can use that also fall outside the sort of 7-year piece I was talking about is something called the gift out of normal expenditure. Now, some of the things that it would need to qualify for to actually be normal expenditure, that these gifts must be regular, So typically this is something that you're paying out, at least annually, maybe quarterly, better even monthly. And that it's intended to continue for 4 to 5 years, or certainly until death. And really important here that it doesn't affect the standard of living. There's also something else to note, and this is the thing of income versus capital. So let's just take a scenario. Someone has a pension, they start drawing an income from it, but they also have cash and maybe they've got investments too. Now, when they take that pension income, they give that income away, but they're living off the capital of cash and/or investments. Now, when they assess things, they would look at that and they would say, well, you're actually living off capital and that's not income. So really important to be careful on this and to do it properly. Another gift allowance is £3,000 per year. So you can give this to one person or split it between multiple people. There's also a wedding allowance. So that's £5,000 per child. It's £2,500 per grandchild or great-grandchild, and £1,000 to anyone else. There's something else I want to talk about though, and that is gifting investments into trust. And the two main types I'm going to talk about today are taking an income from the investments and one that would provide more flexibility. Now, the advantage to doing this is that you can retain control over the money, and you can even potentially protect money down the bloodline. So what you do is you have an investment and we place it into the trust. Now, when I've talked about potentially having an income, what happens is you set this up at outset to have a certain level of income. We could set it up so there wouldn't be any tax payable on that income. And irrespective of when you die, so even if you died shortly after taking it, this is underwritten. And what they do is they work out how much they think you would take as an income within your lifetime. So immediately upon death, whenever that is, that amount would fall outside the estate for inheritance tax purposes. The rest of the money, this is a gift, takes 7 years. Now, the alternative version that I'm going to talk about now is the one that gives you more flexibility. So with that income, there is no flexibility. You set it up and it has to remain at that. You can't stop it. And of course, there wouldn't be any point in doing this if you just then took the income and it went in a bank account and you died and had all that money stacking up back in your estate. So the flexibility side is a version where you can decide how much you want per year, and you have the flexibility of taking that on or not each year. So for example, let's say you wanted the option, you have a sum of money, you invest, place into trust, and you want to be able to take £10,000 per year. Now, at the end of that year one, you don't have to take that money. And if we fast forward for a moment and say, after 7 years, you had the option of having £10,000 per year, which you could have taken or not. If you'd taken nothing by year 7, you would be able to access 70,000. Now, the benefit to having not taken it, if you were not going to spend it, is that you've now survived the 7 years, and therefore all of this money has fallen outside the estate, and so has the rest of the capital of the investment value of the bond. And so you can see here that you've got way more flexibility, but the trade-off is it takes all of it 7 years to fall outside the estate. So really, really good option for some people. So the next one I'm going to talk about is business relief. The great thing about this is that you retain ownership. So there is no gifting involved. Now, it takes only 7 years, only takes 2 years to not be subject to inheritance tax. And there is a solution that actually offers 100% reduction in inheritance tax from day one. So it actually has built into it some life insurance. But some people hear about this and they think this is way good to be true. It can't be true. Why on earth does this exist? Surely it's not real. Well, interestingly, some of you may have heard of it, but for those that certainly haven't, it's been around since 1976, so a long time. And it was really set up to help family-owned businesses. And the reason for this, and small businesses in general, is that 16.6 million people employed by small and medium-sized enterprises, and that's 60% of the private sector. So you could see why this might exist, because if you think that a company pays corporation tax, it pays wage, income tax for employees, it pays national insurance tax, it moves money potentially within the economy, it provides a service, it provides jobs. So if suddenly all of these companies had to pay 100% inheritance tax, it would have a massive negative impact on the economy. So it's really important that you hold shares in what's called a qualifying company. So it qualifies for this business relief, because not just anything will. And the good news is there are packaged products available that do this. They've been running for over 10 years. And what they look to do is de-risk that as much as possible in terms of your underlying exposures. But another thing to note here, so again, within the budget, there were some announcements, and that's that as of April 2026, only up to 1 million will obtain this 100% relief. Now, anything over that will still get relief, but it's just at 50%. So instead of being taxed at 40%, it'll be taxed at 20%. Also worth noting, although there are these limitations, with some clever planning, a couple could get 4 million into business relief schemes that could qualify. So at this point, I just want to take a breather and say that these are all inheritance tax solutions. So whether or not your pension is causing a problem or causing the problem, you could use those ones I've mentioned thus far. Now, pointing at you to say that this one here, this bonus point, is something that you could do. Beneficiaries drawdown. So, what is this? Now, this is something relating to your pensions. So, if your pension allows for beneficiaries drawdown, I mean, first of all, I would make sure that you ensure that it does. But what it means is the money upon death can retain the pension environment. So when we review plans, what we regularly find is that the scheme offered, or the person that holds his pension, doesn't have this option. And so upon death, it will have to pay outside of the pension. And even if it does offer it, often it has a limitation. For example, maybe the beneficiaries have to be of a certain age. So with beneficiaries drawdown, you can have a pension plan. You don't need to be at a pensionable age, and you can draw on it before a pensionable age as well, potentially. So really important that the plan does offer this, and that your beneficiaries are up to date. So again, what we regularly find reviewing plans is that there are either no beneficiaries on there, or they're very outdated. So regularly find things like maybe an old partner, a parent, or someone that's deceased and not up-to-date beneficiaries. So these are things you can check right away and make sure that your plans allow for. Also, if we think, I mentioned, actually, I'll probably come on to this point further along. No, sorry, I did mention it about the over 75 and dying, that you would pay income tax if it pays outside the wrapper. But if it offers beneficiaries drawdown and it passes on within the pension, that won't happen whilst it remains within the pension. So it's really important to ensure that there's someone there to help manage this upon death. So of course, this is something you could do yourself or let someone know, but they really do need to know what they're doing. This is obviously something that we do for our clients. So, because what may happen is it may allow for beneficiaries drawdown. The beneficiary hears, I can have this money, they get it to pay out, and suddenly they're taxed a load of money they didn't necessarily need to be. So another point I want to make here is around, I know it's difficult, I know none of us like these news in the budget that taxes are going up, but not to panic. So if your pension is the thing creating the problem, remember, actually, as of this point today, there is no problem. And it is still a really tax efficient way of investing. It's just on the inheritance tax side, it's not as tax efficient as before. It's also worth noting on this point that there was a consultation which closed at the end of January this year. Now, they regularly do this with new legislation, but there was record-breaking response in terms of the volume. Also worth noting that the focus of this was how inheritance tax will be calculated and paid, not whether it will be taxed. So they asked providers for their feedback on it. Now, I must admit there's a little, maybe slightly ambitious wish here that they will change this, but we can't presume they will because they have said they're not going to. And I do know that a lot of the feedback has also been that this isn't going to work and it can't work. And can we not have an allowance for pensions? Really, what we used to have. But so what it does say at this point is that schemes will have to pay out inheritance tax in 6 months. And this seems very unrealistic because the average estate takes 90 months to settle. And anyone that's been through this kind of a process will understand this. If you also think within a pension, you've got underlying investments, you could even hold commercial property, and that could easily on its own take a year to sell down. So we don't know how this is going to work. How is it going to work? And until we know that detail, then it's hard to make a full plan on it. But I just want to point out, if you are over the age of 75, for some, it could make sense to consider acting sooner. So for example, your pension is there purely as an inheritance tax tool. You have other assets to support yourself for your lifetime, and you're very sure of this. You do not need this pension. So for someone in that scenario, you could maybe consider withdrawing from it to help with the inheritance tax planning. But again, be careful, because if you draw out a lot and you may be taxed very highly, it needs to be done in a very thought out way. So clearly, I would say get some professional help, and certainly if you need it. This is a complex, and the correct solution does depend on your situation. So speaking to financial planners, or what you may think of as a financial advisor, so people like us, they can assess the right solution based on your personal circumstances. So to summarize what we've gone through, we talked about how to work out if you have an inheritance tax problem. We've then talked about how does your pension factor into this. We went through then the solutions, being you could spend it, you can insure it, you could gift it, talked about business relief, and then the bonuses, beneficiaries, drawdown, and the fact that keep calm, carry on, don't panic. Let's see what also comes out of this consultation when we get feedback. We don't know when exactly we're going to hear for the detail on that. And just finally on that point, to get professional help if you need it. Now, we do provide a lot of free content. Paul mentioned earlier that we will be having quarterly webinars, so keep your eyes peeled. We have a free newsletter. If you're not receiving it, you probably should be, then do get in contact. That comes out every month. We regularly write guides on different things. The last one, in fact, was on cash flow forecasting. We have free articles on our website. I post almost daily on LinkedIn, so you can see my name here. do follow me or connect, and you can get more free content there. And lastly, we've reset up our Instagram account, so do have a look there. Look for MLP Wealth. You should see us there. So, Paul mentioned earlier, we're here for you if you need. We're happy to have a free chat, see how we can help, if we can help, whether it's just to answer a question, whether it's something more detailed. So here, if you get up your phones, you can scan these QR codes. We'll see who's more popular, or maybe no one, but you can scan this on your phone and it will take you to a direct booking page. So I'll leave that there for a moment. Now, for anyone that doesn't like doing that, I've just put our email address here. I've put our phone number. Just get in contact and we will be happy to speak to you in one way or another. So I'll just carry on and leave that for a moment if people are sort of fumbling around for phones, etc., or making a note of this, although the recording will go out so you can always look back. So really, it's now just to move on to the questions and answers. So at this point, I will ask Paul, who's been keeping a beady eye on the Q&A section, to come back in here and let me know of any questions we have. So I can't quite see Paul at the moment. I'm just going to check then if he's having a technical difficulty there. If I can myself find any questions.
Hear me, Sean?
Yes, I can. Are you back?
Yeah, for some reason.
Oh, here we are. I can see you now.
For some reason, it kicked me out. I don't think we actually have. Oh, we got one question in the chat. When you say you can gift 3K per year, is that 3K overall or to each person?
Yeah, so on that slide, so if you do watch this back, it's 3,000 per person, or you can split it between as many people as you like. So it's just an allowance of £3,000 per year, that one.
So I think, Tanya, to answer the question, it's just one allowance of 3,000. While we wait to see if anyone else has any questions, I'm just going to ask you a couple of things, Sean. You mentioned, I think it'd be good to give a little bit of further clarification on the difference between capital and income. You mentioned turning on a pension to provide an income for you and then giving away your capital. Could you just explain the way that the HMRC may look at that?
Yeah, so, and do let me know if this isn't clear. What you can't be seen to be doing is I'm taking an income, let's just, talk about some figures, £1,000 from a pension, I gift that away, but then I'm taking £1,000 from capital that's in cash or investments on the other side. And so what they'll do is they'll look at your whole situation, not just, oh, you're taking that income and you're giving your income away. They would say, well, you're actually now living off your capital and your assets, and therefore that wouldn't qualify. Does that answer it?
I think so. My understanding currently, and obviously these things are nuanced, is that if you turn on an income and give it away whilst living off capital, the HMRC could look at it that may take a view that you're living off the income and you're giving away the capital. So it's just something to be careful of. Barry's asked, can you backdate the 3K allowance? Do you know the answer to that, Sean?
I'm pretty sure you can't. I might look that up, but that is a per year allowance, so I believe not.
I don't think you can either. There's quite detailed explanations of this stuff on the .gov.uk website, so it's worth double checking there. Alison has asked, if you give a family member £3,000, do they have to pay tax on it? or do we pay tax on it?
No, so obviously, if it's just some money that you have that you gift away, no, there's no tax to be paid.
Yeah,
Clearly,
I
sorry,
think the
just to
point is,
expand. Sorry, Paul, just to expand on that, clearly, if you drew it out your pension, you might have to pay tax, depending on how you took it. But the gift itself, no, there wouldn't be tax on that.
okay. One thing that may affect a few people on here, which I think you touched on, Sean, but maybe it was worth spending a little bit more time on, is the potential unintended consequences, and specifically the tapering of the RNRB, or the residence nil rate band, the extra 175 that people are entitled to, should they be passing on a home to direct descendants. How could that be affected by the proposed legislation to bring pensions into the estate?
So sorry, the question is could the RNRB, the residence nil rate band, be impacted by the pensions now being in the estate? Yeah.
That's correct, yeah.
Yeah, really good question, actually. I like that one. So that one, so what I mentioned about the tapering, right? So suddenly now, if you've got a pension, let's take an example. I said that it's tapered, so therefore, if your estate's worth over 2.35 million, you lose the RNRB. So for someone that has a pension that takes them over the 2 million mark, where if we ignored the pension, because at the moment it's not subject to inheritance tax, suddenly they could be losing either part or all of that residence nil rate band.
Yeah, just to add there, Sean, just for clarification, if you can, your residence nil rate ban, if you're a married couple and you're carrying forward allowances, doesn't completely taper down to zero until you reach about 2.7 million pounds in total estate. You're obviously referring to a single person where we
Yes, sorry, yes, good point.
And I think there's no more questions in the chat at the moment that are, oh, hold on, sorry. I've been putting, Tanya's asked, I've been putting 2,880 for my sons into a pension. Is this therefore not allowed?
Well, that's pretty hard for me to answer at this point because I don't know where that money's coming from. So is it out of normal expenditure? Is it a one-off gift? How many children did you say they are? So it would need to qualify for one of the allowances in order, if it were to just be a gift and it's gone. Otherwise, potentially it would take 7 years.
Yeah, I think that one-off gift. If it's a one-off gift, then it's not going to qualify as a gift under normal expenditure. But so I think that would potentially be a potentially exempt transfer. But I think, Tanya, if we want to go into more detail, probably the best thing to do is to actually have a chat about this offline, because we're getting quite specific now. Finally, Sean, I just thought one last thing that's worth asking is, obviously it's not easy to get money out of pensions without paying substantial amounts of tax sometimes. But obviously we do have currently the tax-free allowance available of 25%, generally speaking. How could that be used in conjunction with business relief potentially going forward?
Yeah, so if we're talking about a scenario where, we want to do inheritance tax planning, it all makes sense, we tick boxes, you could potentially take out that tax-free cash and put it into a business relief scheme. So the benefit to taking it out is you've got it out tax-free. Of course, this leaves less or none if you take all of it for you, if you need it as an income, and anything else would be taxed upon. But for inheritance tax purposes, you put it in that business relief scheme. After only 2 years, it then would not be subject to inheritance tax.
Of course, you can do similar things with trusts, but the outcome's different. Just mindful of time, so we'll try and stay on time. It is now 7:45, so I think we're gonna try and wrap everything up there. So I'd just like to say thank you for everyone who came today, and I hope you picked up some useful information. Again, just following up what I said before, we will be sending out a recording, of the webinar to everyone who's attended. And should you want to get in touch and have further conversations on a specific topic raised, then please either use the QR codes that Sean brought up or contact us directly. So thank you very much, everyone, and enjoy your evening, whether it's the football or anything else. Cheers.
Bye.
All right.